welcome everyone. Another great video. We get frequently asked about the RRSP meltdown, how to minimize the tax. We've done lots of videos on that, and we're going to tackling that topic a slightly different way today. So now you're doing the RRSP meltdown, you have that non-registered account. How do you minimize the tax there to make sure you end up taking more out of the RRSP? Let's tackle that.
Yeah, basically, like as we said, we're not dealing with the TFSA. We're melting it down. It's got to go to a non-registered account. So what we want to do is basically look at 3 tips that we can try and deal with this to try and make it even more tax efficient and better for you going forward. And basically those are, the first one's dealing with asset location, which we'll get into and describe exactly what it is. The second tip will deal with whole life insurance. And our third one will deal with that corporate class investments and how all 3 of these can minimize your taxes while taking that money out of the RRSP.
Yeah, and a quick explanation. So the RRSP meltdown, you never want to dial lots of money in your RRSP.
Never.
If you can avoid it, don't do that, because it's a big tax burden. You can go tax-free to your spouse. Anybody else, that RRSP is fully taxed upon passing, which can create a big liability, which is why people try to melt it down instead of deferring it and then having this big burden when they pass away. They do it in little bits and pieces as they go. And commonly, you might take it out of the RRSP and then put it in your tax-free account. But if your tax-free account's already full, it's got to go into the non-registered account. And then that non-registered account is also taxable, and that creates the situation we're dealing with today. How do you handle that non-registered account, minimize that tax? We talked about 3 strategies. The first one there, asset location, is one of the ways you can handle it.
Yeah, and what we're dealing with asset location is, where do you put your investments? I mean, theoretically, anything that earns pure income, you want to make sure that that's as tax sheltered as could possibly be. So whether that's your TFSA, whether that's your RRSP, it doesn't matter if they're paying income out as a distribution, that is all tax sheltered, so you don't want to worry about it. You'd rather put things in there. When you start earning capital gains, return of capital, or even dividends, those are investments that you want to start looking at for probably the non-registered. So when we mention asset location, things that earn income, we want to keep those basically in the RRSP and the RIF, the TFSA. Things that are earning a better tax break scenario is what we're going to want to put in the non-registered, and that's exactly how we divide it. Get our non-registered assets in that class and keep our registered assets more on the income-oriented basis.
Yeah, and that's the idea. The idea that maybe you have a mix of investments. Let's say you're a balanced investor, so you've got a couple of pieces in the puzzle. Instead of having every single account being exactly balanced, you could say, all right, of that balanced portfolio, there'll be pieces that are more tax-friendly. Those will be the pieces we put in a non-registered account, which will lower the tax bill there. And the other ones we'll keep in the RRSP and the TFSA, because they won't really matter. They're all taxed the same from those accounts, regardless. And that kind of mixture overall lowers your tax bill, which would be one way to help out. Now, pros and cons of everything. There's always trade-offs. No magic solution, just trade-offs. And for this strategy, you kind of need similar size accounts. If your non-registered account of that bucket is really big and your RRSP and TFSA are smaller, well, if you load up on strategies that are tax efficient in the non-registered account, that could mean you end up with a lot of growth stocks, as an example, which could be way too much risk and could put your plan offside. So you have to always remember the priorities. You want to start with your goal, want to make sure you have an appropriate plan, make sure you have a good understanding of your risk level. Then you get into the investments and the taxes. So you have to keep that order in mind. But that was one idea. The second idea here has to do with whole life insurance.
Yeah, and the whole life insurance scenario is, you know, you're putting the money away, you're getting it tax sheltered now outside the RRSP, which is even better because you're taking it from one tax sheltered investment, basically putting it into another, and then that way it's going to continue to grow. It's got investments in there that are all sheltered. It's got an insurance scenario that goes along with it. But again, as you've mentioned, the sort of scenario is there's the pros and cons to it, is the fact that once it's in there, well, you're not touching it. That's got to be gone for a long, long time for down the road. So theoretically speaking, this has got to be money that you can afford to put away. So if you were looking to take it out of the RIF and put it into your non-registered and spend it down the road, well, that may not be an option. So again, that's something you have to consider, but it is another method to try and shelter everything that we have.
Yeah, and ideally, usually best suited for low-risk investors, conservative investors, because the rates of return on insurance can be okay, but likely not going to be better than, say, if you did your own stock investing.
That's right.
So this might be for someone who's more conservative in nature. Well, you get in a more conservative strategy. It's minimizing the tax, but again, like you mentioned, not suitable for everyone.
No.
If you said, hey, I'm going to spend all the money in that account as part of my retirement plan, well, don't do this.
No, this won't work.
Because this is really more for the estate.
Exactly.
Passing money tax efficiently to the next generation, and then while you're alive, it minimizes your tax bill in addition to that. The third strategy here, so we talked about asset location, we talked about whole life insurance, still looking at that non-registered account, how to minimize the tax bill. The third option is corporate class investments. Now that's a bit of jargon there. And corporate class is a structure that was created to really pass down and convert the type of tax you pay on your investments. So instead of it being fully taxed today, it effectively becomes like a capital gain, which you pay down the road when you sell the investments. Now, capital gains tax is better in terms of the tax rate compared to, say, interest or to a dividend.
Yep.
It's more tax favorable. And that's what these corporate class investments do. Now, a couple of words of caution. The government has changed the rules around this in the past, so they perhaps could change them again in the future. And then also, not every strategy is available in a corporate class structure. Often you have to buy a mutual fund or an ETF that has this corporate class wrapper, and then you benefit from that tax strategy, but not all strategies will be applicable for that corporate class.
That's right. And it only applies to certain areas that you want to deal with. You may want to try everything that way, but not everything makes itself into a corporate class. So again, I mean, these are three strategies you're dealing with. If you want to know more about the RRSP Meltdown, though, we can go in a lot higher or a lot more detail and less high depth than we're going right now. By all means, get in touch with us at chatwithclintonandkevin.com on the website. Send us that questions you've got on RRSP meltdowns or any other financial questions you want to know anything about. We're more than happy to answer those. It does go to Clinton myself. It is not going to some robot or anything in the background. So you will get through to us, and that's a big factor. But these are sort of the three areas that we wanted to concentrate on, were the asset location, the whole life insurance, and the corporate class strategy, as being something that can help you moving it to a non-registered in that RRSP meltdown scenario.
So minimizing the tax hit on that non-registered account can be beneficial in many ways. We're using it in terms of the RRSP meltdown. So there's less tax from that non-registered account. That keeps your income a little lower, which allow you to pull more out of the RRSP. Some folks just want less tax in general, even if they're not pulling more out of the RRSP, and they could use these strategies to minimize the tax on the non-registered account as well. We have another great video on the screen now, so feel free to click on that one, and we'll see you again very soon.